Hello and welcome. My name is Benoit Poliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management, and you're watching the first quarter 2022 quarterly review, where this quarter's review is really about interest rates, which was the overriding theme, if you will, or the biggest newsmaker of the quarter, and the impact, or had the largest impact on investors worldwide. As always, we've broken down this report into two videos, a short one, just a quick synopsis of what happened in the markets, and a longer video where we show you data and charts that went into the conclusions. Thanks again for watching. So let's look at the performance highlights. So what we've got, Canadian markets roared. We had 3.8% for the quarter, and we are closing out on 20%. The index closed, the S&P TSX Composite total return, well, that's price appreciation plus dividends reinvested, closed at almost 22,000. In the US, we had a negative quarter, minus 5.6, and we had a total performance still very respectable, 15% on the past 12 months. If we move to the NASDAQ had the technology heavy NASDAQ had minus 10%, which was a heavy month, and in Europe, minus 6.4%. The large reason for the negative return on the NASDAQ was high interest rates, which have overwhelmingly a higher impact on growth stocks. And in Europe, obviously the war in Ukraine had an impact on that continent's investor appetite, if you will. The one-year performance numbers in NASDAQ is down to 7%, so about half the S&P 500. And lo and behold, our Canadian index is now one of the leaders globally on a 12-month basis. Emerging markets still having a rough go. So emerging markets, 50% of that index, the MSCI emerging market, is made out of China, or composed of Chinese stocks, and they, along with the rest of them, the whole index, posted a minus 8.3% in Canadian dollar terms, and for the past 12 months, we're looking at minus 13%. Not a whole lot going on in terms of the currencies, but oil is an absolute rocket ship, up 33% on the quarter, up 70% in the past 12 months. Closed effectively at $100 mark, was well above that during the quarter. Interest rates, well, they're rising. Canadian government, Canada, one-year bonds are at 195. 5-year bonds are at 248, let's call it 250, and there's about the same rate for 20 years out. GIC rates, just as an indication, 2.6% for 1 year and 3.4 for 5-year investments. Let's move over to performance attribution, changing up that chart a little bit, adding sectors as well as names. The idea is to show you that the S&P 500 was dominated by the inflation story and the rising interest rate story, and as well commodities absolutely booming. So any sector that benefited from rising interest rates, rising inflation, and fear in terms of gold, or the ability to pass on higher prices, did very well. Oil and gas, the integrateds, the explorers, fertilizers, agriculture, so on and so forth, really, really strong quarter. Conversely, the worst performing sector was anything related to housing. With higher interest rates, investors are starting to worry about how the consumer will react to both the housing sector and the expenditures associated with housing. In Canada, more or less the same story. We're looking at energy and materials having a fantastic quarter. And on the negative side, real estate, consumer discretionary, and technology names really lagging. If we look at specific names, we're looking at oil producers, we're looking at agricultural products and fertilizers. And on the downside, we're looking at some. What's interesting here, and what's why I'm putting this chart up, is we have the old Facebook, now called Meta platforms. We have Netflix, PayPal, and Etsy, which used to be on the leaderboard, are now come back to earth. Moderna is down 33% as well. So kind of a mixed bag, but yesterday's winners are turning into the worst performers. Same thing in Canada. We're looking at Shopify down 50% on the quarter. We're looking at Canada Goose, Trisura, Aurora. These were all names that used to be the top performers, 12, 18, even 24 months ago. Let's look at interest rates because it's really what drove this quarter's performance. So the white line is what we call the yield curve. So basically, you've got the axis here, which is time. So if an investor wants to put money away for 5 years, they would, at the end of last quarter, which is the end of March, just under 2.5%. If they want to put away money for 15 or even 20 years, you're looking at slightly above at 2.5%. And if you want to put the money away for 30 years, you're actually making less than if you put it away for 20 years. So you're back to levels that look like the 5-year money. So another concept important here on this Canadian yield curve is we're looking at the red line is where the interest rates finished at the end of last year, 3 months ago. And the blue line is where interest rates were a year ago. Concept here, interest rates rose dramatically, especially in what we call the short end of the curve. Let's call it 10 years and in, where interest rates really went up dramatically. The U.S., very much the same story we're looking at, but it's actually an odder shape, and we're going to talk about something called yield inversion, which is 10-year yields paying less than 7-year, 5 years, and this is a 3-year number, and the 2-year number basically paying the same as a 10-year number. So we're looking at an inversion here. Depending on how you calculate, we're going to look at the difference between the 2-year and the 10-year number, which is, you can't really tell on the chart here, but it's slightly inverted. The 20-year to 30-year number is inverted. It happens more often simply because there's a supply and demand mismatch very often. There's not a lot of issuers on the 30-year mark, and so sometimes there's more demand for that product, which raises prices and lower yield. But really the idea here is to look at that kind of wonky shape that we've got going on. This sort of turquoise, my attempt at the blue line, that number is where things were a year ago, and that's a more normal shape, if you will. As you go out in time, you get higher interest rates, and that's called a steep curve. This is called an inverted curve. So investors, we're going to talk about it in the longer video. We're really worried about this inversion, in yield curve inversion, and they're also worried about rising interest rates, which has a longer impact or a longer term impact on growth stocks. So what are we looking at for 2022 and beyond? Well, what stays immutable? We want to look at shareholder friendly, ideally dividend focused, quality balance sheet, proven management, global approach. We don't want to overpay for assets, and we're willing to sell them when they get crazy expensive. We want to stay away from headlines and not get influenced by them. But we want to be open to a wide range of outcomes, and we're going to talk about that a little bit more. We're getting data that is pointing to, not immediately, but certainly an economic slowdown. Adjustments, well, interest rates, they're rising clearly. We initially 6 months ago, we were talking about transitory versus permanent. Clearly, the conversation is interest or prices have risen dramatically. Will they stay at this higher level, or will they continue to rise up like the 70s? Consumer discretionary, what kind of impact higher prices will have on that kind of spending and income, housing, and inflation. Migrations, I think that story is probably going to play itself out. We're towards the end where the pandemic has really made the shift, or people have already made their shift. So whether it's outside of the downtown core, question is, will that revert? Or moving towards secondary cities, both in the U.S. and in Canada and in Europe. Geopolitics, 2 years ago, if you look at mainstream media, everyone was inviting an expert on whether it's the flu and other infectious diseases. Now all the guests are talking about the history of Eastern Europe, or the history of relations between Russia and the rest of the world. So the narrative in the media has certainly shifted, and that has had an impact and will continue to have an impact on investor psyche. In government policies, they remain an issue for us. Government, we're in an era now where governments are much more involved in our economic lives. We have a new budget coming up here in Canada, so that will have an impact, obviously, on taxations. Will they go up? What type of taxation schemes or schemes will the federal government come up with? Thank you very much for watching. I would invite you to watch our charts and data video for a more in-depth study on the events of the past quarter. And if you have any questions or comments, feel free to send us an email. Thanks again for watching.